The biggest mistake traders make isn't where they enter, but moving their stop to break even before the market has actually validated their trade premise. Every single trade begins with a premise. Before you click buy, you must know exactly where that premise is proven false. That specific price point is where your protective stop belongs. In price action trading, the standard initial stop placement is precisely one tick beyond the signal bar. If you are buying a reversal or a breakout, your stop goes one tick below the low of the bar that generated your signal. The logic is mathematical, not emotional. If the market drops below the signal bar, the momentum you were betting on has failed. Staying in the trade hoping for a turnaround turns a probability play into gambling. However, context dictates the width of your stop. In a strong breakout or spike phase, you use a tight stop below the breakout bar. The market is moving fast, and any pullback deeper than that indicates the breakout is failing. Conversely, inside a trading range, tight stops are disastrous. The market in a range lacks momentum and frequently hunts for liquidity. Here, stops must be wider, often placed below the most recent major swing low, not just the signal bar. This brings us to the concept of risk versus probability. Tight stops offer great reward-to-risk ratios, but they have a lower probability of holding. Wide stops have a higher win rate, but require smaller position sizes to keep risk constant. Sometimes, the signal bar is too small. If you enter on a tiny doji bar, a stop one tick below is too close. Normal market noise will stop you out. In these cases, use a catastrophe stop based on the average true range or a prior swing point. Once the trade is active, the most critical decision is when to move the stop to break even. Most novices do this too early to eliminate emotional stress. This is a mistake that kills profitability. Do not move your stop to break even until the market has made a new structural high or a strong breakout in your direction. The price often comes back to test the entry price before the real move begins. The correct time to tighten risk is after a breakout test. If price breaks a resistance level, pulls back to test it, and then resumes the trend, you can safely move your stop below that pullback low. Now, let's discuss trailing stops. Never use an arbitrary number like 20 points. The market does not care about your arbitrary number. You must trail your stop based on price action market structure. In a bull trend, your stop should trail below the most recent major higher low. A major higher low is a pullback that led to a significant new high. If the market breaks below a major higher low, the trend is likely over. In a bear channel, the logic is inverted. You trail your stop above the lower highs. As long as the market keeps making lower highs, the bear trend is intact. A break above a lower high signals a potential reversal. There is a special case for climactic moves. If the market suddenly accelerates vertically after a long trend, this is often exhaustion. Here, you tighten your stop aggressively to the low of the previous bar to lock in windfall profits. Let's review the trader's equation regarding stops. Your stop distance determines your position size. If your technical analysis requires a wide stop, you must reduce your share size to keep your dollar risk constant. Often, you will get stopped out, only to see the market immediately form a second signal in your original direction. This is a second entry or a stop run. Do not be afraid to re-enter. Professional traders treat a stop out as just information. It means the timing was slightly off. If a second signal bar forms right after you were stopped out, the probability of success is often higher than the first trade. Let's look at the vacuum effect near support. Price often accelerates downward right before a reversal, specifically to hit stops below a swing low. This is why placing stops exactly at a support level is dangerous. To avoid the vacuum, give your stop wiggle room. If the swing low is at 150.00, don't place your stop at 149.99. Place it at 149.90 or use a measured move projection to find a safer invalidation point. Another advanced technique is the time stop. If you enter a trade expecting a breakout, and after 3 to 5 bars the market has gone sideways, the premise is weak. Exit at the market or tighten the stop immediately. Remember, a stop loss is not just about losing money. It is about capital preservation. You cannot compound your account if you take a catastrophic loss. The stop loss is your survival mechanism. When trading reversals, your stop must go beyond the absolute extreme. If you are selling a top, your stop is above the highest wick. If that high is breached, the trend is making higher highs, and you must be out. In a broad bull channel, stops can be looser. Often, price will undershoot the trend channel line. A stop placed strictly on the trend line will be hit. A stop placed below the prior major swing low is safer. Never widen a stop loss once the trade is live. This is the cardinal sin of trading. If price is approaching your stop, your analysis was likely wrong. Accepting the small loss releases you to find the next opportunity. Let's summarize the hierarchy of stop placement. First, technical invalidation points, swing highs/lows. Second, signal bar extremes for strong momentum. Third, measured moves for volatility protection. If you are unsure where to place your stop, you should not be in the trade. The stop location determines the trade size, and the trade size determines your psychology. They are all linked. For swing trading on higher time frames like the daily chart, stops must be wide to account for overnight gaps. A stop that is too tight on a daily chart will be triggered by meaningless intraday noise. When you have a runner, a portion of your position left after taking partial profits, the stop on the runner should be loose. You have already locked in profit, so give the runner room to capture a massive trend. Ultimately, successful trading is about defending your capital. Your stop loss is the cost of doing business. It is an insurance premium you pay to protect your account from ruin. Review your past 20 losing trades. Did you move your stop too early? Did you place it based on a dollar amount instead of the chart? Adjust your behavior based on this data. Now that you know how to protect your downside, the next logical step is defining your upside. Without a target, a trade is just a journey to nowhere. In the next video, we will cover profit targets, how to use measured moves to know exactly where to take your profits. Click here to continue the course. Master your risk, because the market offers no refunds.